Inflation in the United States hitting its highest level in nearly 40 years. Consumer prices jumping 7% in December from a year ago. Our next guest says high prices are more likely to persist over the next couple of years rather than become transitory. Joining me now, former IMF chief economist, Harvard University economics professor, Kenneth Rogoff. Ken, it becomes entrenched. People, they experience high prices, they demand higher wages, and it becomes this nasty spiral. What say you?
Yeah, well, that's the danger. I mean, I think the Federal Reserve and other central banks were sort of counting on being like the Bank of Japan, where no matter what they do, inflation doesn't seem to go up. But it's not as entrenched here. So wages have been trailing prices. Yeah, they're ahead of productivity, but they've been trailing prices, and there are going to be pressures on that. The service sector, if the economy comes back, it's going to take a lot of wage increases to bring people back. People are feeling a lot of pricing pressure. And yet people see it 1 year and they think they're confused. It's the pandemic. I think they're going to see it this year, too, pretty much. Very likely, unless the pandemic really takes a turn for the worse. That's a couple years in a row. I think, that really is going to be difficult to push back on.
John Hilsenrath from the Wall Street Journal is here. John, jump in.
Hi, Ken. I got a couple questions for you. One relates to the Fed and inflation, as you were just talking about. As you know as well as anyone, the Fed has a 2% inflation target. I believe that they take that target seriously and that they're going to get inflation back to that. So for me, the question is, what are they going to have to do to get inflation back to the 2% target? And what are the consequences of that going to be for the economy? That's the first question. The other one is, how does China play in to all of this? Even before COVID, a lot of companies were rethinking their supply chains, rethinking how much they wanted to depend on Chinese manufacturing. Then we had COVID, which caused all kinds of additional disruptions. How much of the supply chain bottlenecks that we're hearing about right now are part of some bigger shift out of China, reconfiguring supply chains that perhaps might stay with us for some long period of time?
Start with the Fed first, Ken.
Yeah, so I agree they take the 2% target seriously. They also take having a recession seriously. And I think the question is, how much are they going to have to step on the brakes to really slow inflation down? I believe them when they say they're going to go for 3/4, maybe a % increase. But they haven't tried to raise interest rates to stop inflation really for almost 30 years now, since the early 90s. Since then, every other time they've raised interest rates, really been more about financial stability. It's not clear how it's going to work. No one quite knew why inflation fell so much. Nobody quite understands the dynamics. There's a lot of uncertainty there. My guess is they'll have to raise interest rates eventually more than that. They're going to raise interest rates 0.75%. There may be a big impact on the stock market, maybe not, but I'm not sure that'll be enough. On your question on China, there's a lot going on there. If China, I don't think we can easily move away from China. Take a long time. That's a long-term supply problem. If their COVID zero continues to cause them problems, and I'd also add their real estate and other things they're dealing with, we could see we could see pressures from China, which are, recessionary in China, but push up prices everywhere else. We could get the worst of both worlds, where their demand pressures in the U.S. with still a lot of pent-up demand, still relatively easy monetary policy, and supply side pressures coming from China, both pushing up inflation.
Ken, great to see you. As always, thank you so much for being here. But to your point on the Federal Reserve, they haven't raised interest rates, just to repeat it, to fight inflation for about 30 years. I started in financial journalism right around, remember that February sudden rate hike that Greenspan did that caused, the Orange County debacle, the bankruptcy there, but also several hedge funds to blow up. But since then, we really haven't seen that kind of, at least that approach to inflation. So, and you've got an unprecedented response from the Fed to COVID and a nearly $9 trillion balance sheet.
You're running down the scorecard, David. So it's not so easy to raise interest rates to fight inflation when public and private debt is high, when stock market's high, when housing prices are high, when the economy is still weak. It takes a lot of stomach. They're certainly not going to overshoot for now on raising interest rates. They're going to be cautious, and that's why I think we'll still have inflation in 2023.
Great to see you, Ken. Thank you so much for being here. Always a pleasure, sir.
Thank you for having me.